In the book, Becoming Your Own Banker, Nelson Nash writes that the average American spends 34.5 cents of every after tax dollar on paying interest. That was back in the 90s. What do you think people are paying on interest today?
If you're spending 34.5 cents on every dollar after taxes, that means if you make $1,000, you only get to use 655 of those dollars for yourself. We're passionate about helping people recover the interest they have to pay so that they can make their money go longer and profit them more.
Just imagine what it would look like if you could recover the interest that you're spending in your life. That's what we're going to talk about right now. Joanne contacted our office. She has $15,000 of credit card debt, 7 credit cards, and 2 personal loans. And the interest is between 18 and almost 35%. That's high interest debt. She's paying $860 a month on these debts. And we're able to look at her numbers and help her see that she could pay off her credit cards in 18 months. And she could pay back the policy loan that she takes to help accelerate her credit card. She could get that paid back in 24 months. Now, instead of just being out of debt, she has over $7,000 to show for it.
That is terrific. That is a great plan because when people are paying on their credit cards, all they're doing is getting to zero. They're paying off those credit cards and they don't feel like they've really done anything.
Right. But now, because Joanne took some time to save ahead of time so she could get her life insurance policy started, she's getting the time that's taking that asset is being able to start growing for her. So she'll be ahead of where she would have been if she had focused all her dollars on paying off the debt first and then tried to start something for her future. And it gives her options too, because right now she has this life insurance policy that she has started. She knew it was a good thing to start. She had taken a policy loan out on it for another purpose. I think she had actually used it to pay off another credit card that was in the picture before we looked at the details. And she has about $1,300 of net cash value. So Joanne can choose to pay off to use some of that cash value to help pay off more debt, or she could decide she really wants to keep that $1,300 in reserve while she pays the other debts off. It only takes her about 2 months longer to pay off the debt if she decides she does want to keep that $1,300 in reserve.
And the amount of money she pays towards that debt, there's a lot less interest that she's paying when she is paying the debt off this way. Isn't that right?
There is a little bit less interest when she is accelerating it as opposed to spreading out her extra payments across several different debts. Because there is efficiency. When you look at the numbers, there's an efficiency to putting all your extra payments onto one debt, the one that's highest priority rather than spreading them out across several. Some of those debts that you're spreading it out over, they may take longer to pay off. So it takes longer for you to recover the cash flow that you put into it.
That makes me think of David in the Bible when he went out as a young boy and killed Goliath. He did that all by himself. The army was scared to death of the giant, didn't do anything. But he went out in the power of the Lord, and he killed and slew that giant and saved Israel. That giant had several other brothers. David wasn't able to kill those until he got the army of Israel behind him, and it was his army that killed those. But David ultimately did it because of his leadership. So
he got the ball rolling.
When we kill a debt, it gives us momentum to go after the other debts that we might have in our life or other giants in our life.
And it's not always apparent which debt we should tackle first. You just gave one example, but sometimes there's multiple debts that it's not very apparent. So you actually use some software to help you determine and help people come up with a plan of which ones to do first.
That's right. Something that's interesting about working on these is Joanne, if she would make the minimum payments on all these debts, it could take a lot longer because a credit card, the minimum payment on a credit card is typically between 2 and 4% of the balance. Sometimes the minimum payment could be higher than that. But let's say that Joanne was just making the minimum payments and that it was going to take her 10 or 20 years to pay off these credit cards. That's a lot more volume of interest that's going to the credit card company. By accelerating and getting that debt paid off, she should continue the cash flow that she was used to paying on those credit cards that would have gone to the credit card company. Now that can come back to Joanne's pocket and make a profit for her. That's how you recover interest that you would normally pay to a bank.
So what we're talking about here is we're talking about the cost of finance. And the cost of finance is huge. Back in the 90s, it was 34.5 cents of every dollar you earned. And that leaves you with, 65 cents of every dollar that you can spend. So how do we help people to overcome that cost of interest?
Well, people pay the cost of interest on a lot of things. They pay it on credit cards, on cars, on home mortgages, on business equipment that they buy, on major personal items that they finance. They even lose interest when they pay cash. That's a hard one for people to understand, but it is part of the cost of finance.
That is a very hard one to understand, speaking from someone that had to learn that lesson personally, because I never wanted to pay interest to anybody. We paid our first house off in 5.5 years. Our second house we paid cash for. We paid cash for our cars. We paid cash for everything. I paid cash for my college education. And I thought I was winning the financial game, and I wasn't. That is not the way to win a financial game. Debt is not a dirty four-letter word if you manage it. But we have to understand the cost of finance and how interest works for and against us to be able to manage debt properly so that we can get ahead financially. For example, let's say that we have $10,000 and that we're saving at 6%. Now, I don't know where you can get 6% today, but I remember back in the day, we got 6% on our CDs. It was real common for us to open a CD and say, oh, it's 6%, 7%. And that compounding over 10 years will come out to be $18,000 and a few extra cents.
18,000?
18,000.
So you had your original 10,000?
10,000 compounding at 6% over 10 years will give me about a little over $18,000. When we saved up $10,000, we made a purchase. I remember buying a travel trailer, and now we thought, we won because we didn't pay interest. But what if I'd financed that travel trailer for $10,000 at 6%? What would I have paid for that travel trailer if I would have paid for it over 10 years? I would have only paid $13,322.
That's surprising to a lot of people because you used the same interest rate.
The same interest rate, but one was compounding for me, the other one was compounding against me. Because when I save, every time I earn 6% on what I've got, it compounds and grows. So when I'm paying something at 6%, every time I make a payment, the compounding takes place on the remaining balance, which is lower because I made a payment. And so that's very, very important to understand if we're going to understand the cost of finance, because paying cash for everything is not managing the cost of finance in our favor.
So one was compounding on an increasing balance. So that's why it grew to 18,000. One was compounding on a decreasing balance, the loan. That's why you ended up paying only 13,000. The difference was time and the compounding working in your favor versus against you.
So by paying cash for that RV trailer, we lost about $5,000 because my money wasn't able to compound and grow. Whereas I would have just let it continue to grow, not added any more to my savings, and taken time payments on the travel trailer for 10 years, I would have been $5,000 ahead almost.
Wow. And it didn't even stop there, because when you took your $10,000 out of that savings account and used it to buy the RV, it not only is it not growing for you for those 10 years, but it's not growing for you for the next 12, the next 15.
Indefinitely until I replace it.
Yeah, and you could carry that cost on forever. You could carry that cost on for a lot of things. It's called the price of lost opportunity.
Yes.
But if you can recover a portion of that cost, you'll be miles ahead.
So we've given some examples of when to use or how to overcome the cost of interest. Credit cards is an easy example. We've also just shown an example of how not paying cash for everything, you can get ahead by earning interest. And now we're going to look at some other examples. What makes it worth it to borrow money to finance? And we've come up with a lot of different examples over the years, trying to help people think outside the box to figure out how can they use the infinite banking concept to benefit them. And Tom, you have an example today of someone who is going to be paying their taxes.
Tammy contacted us, and she has $45,000 that she owes the IRS for back taxes and penalties for not paying her taxes for several years. And her question to us was, do I just take money out of my savings account because I have that money in savings and just pay my taxes and get them off my back? Or do I take the IRS's interest rate at 8% and pay it back over the next 10 years?
And something important to know about Tammy is she had never heard of infinite banking. She does not own a whole life insurance policy. So we're starting really at ground zero. She owes $45,000 in taxes, but she does have $45,000 in savings to pay those taxes. But she's asking us, is there a smarter way?
So her payment to the IRS is going to be like $546 a month if she decides to pay it on time.
Okay.
And over the 10 years, she'll pay a little over $65,000.
That adds to the cost. That's interest.
That's interest. And that we have to consider that. That's the cost of finance.
But what was her original tax bill?
$45,000.
$45,000.
So about $20,000 more goes to the IRS
Yeah.
than what she would have had to if she just took the money and gave it to them. So now we got to look, well, what kind of growth is she earning on her savings right now? And she's earning less than 1%. But even if she could earn 1% on that $45,000 over the next 10 years, it's only going to grow to just a little under $50,000. So it's not going to...
She'll probably have to pay taxes on that interest too. Won't she?
She'll have to pay taxes on that interest. Absolutely. So if she takes the $45,000 out of savings, gets rid of the IRS, pays them off, and takes the $546 she was going to have to pay to the IRS and puts it in a life insurance policy, in 10 years, she'll have $66,000, which is $1,000 more than what she would have paid the IRS.
Are you talking about the cash value of the life insurance?
Absolutely.
So she'll have this policy that has a death benefit, which she isn't really asking anything about. But if she would just go to replenish her $45,000 that she had to pay off to the taxes, then and she acts like I'm going to pay that back to myself, but she puts it into purchasing a whole life insurance policy. In 10 years, she will have
over $66,000 plus a death benefit for her family. Now, the question arises, does she have a cash cushion? Because if all she's got saved is $45,000 and she spends that all on the IRS right now, then if something else comes up in her life, she has nothing to go on except go into debt. So those are things that we all have to think about, and that's why every case is individual. But we have to look at every aspect of it to make sure what is the best thing to put the cost of finance back in your pocket rather than give it to the IRS or to some credit card or to some creditor.
Yeah.
When we get back from the break, we have some more specific examples, specific people using infinite banking to recover the cost of interest they're paying.
If infinite banking is a simple process, why does it seem so complicated? Could it be that infinite banking started out as something simple, but over time has morphed into a convoluted series of buying insurance policies to borrow from insurance policies so you can pay interest on your own money and somehow come out ahead? Could it be that infinite banking has been turned into a catchphrase and is marketed to seem exclusive, something for just the super wealthy or financially savvy? We think the answers to both of these questions are yes, so that's why we're holding a seminar called Infinite Banking Made Simple. This seminar will give you everything you need to know about infinite banking, what it is, and how it works. No mind-bending magic, no number gymnastics, just infinite banking made simple. If you're new to infinite banking, if you're somewhat familiar with infinite banking, or if you've known about infinite banking for a long time, this is the seminar for you. We will be covering infinite banking, what it is, how it works, and how to use it in your life. The seminar is scheduled for May 2nd and 3rd. That's a Friday and Saturday in Indianapolis. Make sure you schedule that time on your calendar now because, as you know, life finds a way to fill up even the most important dates. May 2nd and 3rd. Registration details are on the website linked here and in the description box below. May 2nd and 3rd, Indianapolis. We want to see you there.
Many people take no interest in banking, even though banking has a huge effect on their life. As the joke goes, if you don't take interest in banking, you are not alone.
We are convinced that if you understand banking, start to think like a banker, and start to act like a banker, and become your own banker, that you can get ahead much faster financially.
Banking is a business. So whether you're a business owner or an employee, you need to be able to think like a banker who's in the banking business. Robert was a business owner, and he had a truck to purchase for his business. So he used his life insurance policy loan, and he borrowed $50,000, and he decided he was going to pay it back over 4 years. So his payments were $1,175 a month. Now, the beautiful thing about this is Robert is a business owner. Let's say that his business runs into a cash flow crunch. One of the things that he can adjust is the payment on his truck. Now, if he had decided that he was going to do a 4-year loan from the bank, he wouldn't have been able to adjust that very easily without going through a refinancing process. And if he's going through a refinancing process, the bank might start asking, what's happening to your business cash flow? Not when he has the loan out to his own banking system. He can decide he might take 7 years to pay it off, and his payments would go from $1,175 down to about $730 a month. It puts Robert in control of what he is able to do with his truck loan. Not only is he recovering the interest, but he's also in more control of his cash flow. And that's important to business owners.
And he could adjust a payment. He could charge himself a late fee. He could altogether refinance and, just change his whole payment schedule, all at his whim, because he is the banker and he understands his business. He also understands he wants to make money as a banker, but he understands his cash flow. And so he can make adjustments as he chooses because he is the banker.
He could even pay interest only. It reminds me of Kurt, another business owner who had taken out a number of loans over the years for operating expenses, for payroll, for starting a nutritional program, for doing an office remodel, a lot of different things. He had a number of loans outstanding. He decided to consolidate them. So he had, I think he had taken out a little over $50,000 in loans. He had paid some of those loans down. So by the time we consolidated, there was about $35,000 that was still outstanding. And he decided that he was going to set up interest-only payments to help with cash flow because he doesn't know what cash flow is going to do. So he could set up interest-only payments. He can always pay more than what he plans to when cash flow allows because his business cash flow can be seasonal. That puts him back in control of his cash flow. If he just pays the interest on it, though, he'll pay $5,640 of interest because he's paying 8% on this consolidated loan. He'll pay that over a 2-year period if he just pays interest only. The interest of the life insurance policy during the same time frame is only about $3,500. So he's still making a profit even if he just pays interest only.
And because those were business loans, he still gets to deduct that on his taxes.
If he's itemizing deductions, yes, that can. What happens is it's a tax deduction when the business pays interest to him personally. And he has to claim that as income. So it's kind of a wash in that sense, but he gets money out of the company that didn't have to come out as payroll. And then the interest that's going to the insurance company, that can be a personal tax deduction.
When people start thinking like a banker, acting like a banker, and becoming their own banker, now they can become a banker to other people. And one of our clients, Ted, is a banker to other people. He loans money to friends. And he recently loaned $25,000 to a friend that says, I can pay you back in a year. I can pay you back $26,605. Well, that's about 12% interest. So over that time period, Ted has to pay $104 of interest to the insurance company. So you can see the profit there. It's about 5.5% for Ted just easy money, because that's how banks think. That's how banks operate, by lending someone else's money. In this case, Ted is loaning the insurance company's money to his friend, and he's the arbitrator, and he's in the middle, and he gets to collect the difference between what the insurance company charges and what he charged his client.
Well, I have,
In loans to friends, you want to be careful that you're going to get your principal back. But as long as you're doing that, that can be a great way to make the arbitrage on the difference.
Okay, so I have another example here. Rachel, she has a credit card. She contacted me and said, my husband and I were talking. We have this credit card. We're paying really high interest, and we just thought, why are we doing this? We're going to borrow from our life insurance to pay off this credit card, and we need $5,300. So she borrowed that. But then she contacted me shortly thereafter and said, you know what? We just had some car repairs we had to take care of. Now, normally they probably would have put that on their credit card. But she said, no, let's get another policy loan. So right now they have a loan of $8,643. And she wants to pay $200 a month towards the repayment on this loan. The insurance company is charging them 4%. So that means over a year, at their $2,400 a month or $200 a month payments, they're going to pay $2,400 in a year. But the amount of interest the insurance company is charging them is $345.72. So quite a bit of that $2,400 is going to go towards the principal. In about little over 3 years, 3 years, 9 months, they will have that policy loan paid off, and they will have only paid $681 of interest. So, Rachel didn't tell me the details about their high interest credit card, but we thought, we're seeing credit card interest rates of 29% is what people are reporting.
Even as high as like 34.99. That's basically 35% interest.
Ouch.
Yeah, that's high.
So we just thought, what if they were only paying 21%? Did I just say only? Oh, ouch. What if they were paying 21% and we used that same $200 a month payment? It would, rather than take 3 years, 9 months to pay off, it would take 82 months, which is almost 7 years. They would have paid $7,787 in interest rather than $681. And none of the money they paid, which altogether would have been $16,400 that they paid back, none of that money would be back in their control. Where in this case, they have all $8,643 back in their control. Plus, the policy has been growing and they've been earning dividends.
That's like 47 cents of every dollar she paid on that credit card bill was interest.
Yes.
That's huge.
47.3%. So when we go back,
not 34.5% like Nelson said in the 90s, 47 point what? 3%?
yes.
Volume of interest can be deceiving because you look at the annual percentage rate, and especially when a long loan is involved, like a mortgage. If you look at the first 5 years of a mortgage, it's not uncommon to see 75% volume of interest in those first few years. And when you take into mind that that most people are refinancing their mortgages relatively regularly, I think it may be happening a little bit less often now that interest rates have gone up because people want to keep their low interest rate mortgages. But you think about how often people refinance or move and get a new mortgage, that's a pretty high cost of interest because they're not getting to those later years when you're paying a lot more of the principal.
Not all debt is a dirty four-letter word, like we said earlier. I'm thinking of Jennifer out in Colorado, who took $23,000 loan on a 0% interest credit card. Nice. That's a wise financial decision. Use someone else's money for nothing. However, in the small print of the credit card, it says they can adjust that rate at any time. And all of a sudden, it's going to go up to 24%, just like overnight. And Jennifer says, I want a policy loan because I want to pay this credit card off and not pay them a dime of interest for the use of their money. And I'm going to pay that interest back to myself when I pay my policy loan off. Very savvy, very smart. That's thinking like a banker. That's being a banker. And that's why you can get ahead so much faster.
So for somebody that doesn't have a life insurance policy that they can use as a reservoir to help pay off debt, to help finance things in their business, even major personal expenses, what does the process look like for them to get started from ground zero to being able to run their financing, their self-financing like a banker would?
Well, I think as we've looked at the examples that we've talked about today, every one of them has been different. Yes. And that's why it's so important that you call our office, McPhee Insurance, and you get an appointment and we walk through where you're at. We need to find out what your situation is because every situation is unique. But the process of getting a life insurance policy that you can leverage is very simple. It's just a process that you go through. You go through underwriting. And once we can help you determine what you should be paying in premiums, the rest is fairly simple.
Yeah, a lot of people, when they're looking at life insurance, and it seems like a big jump to get from where you are now to how do you get through underwriting? How do you get a good policy? That's the process that we can help you through. We can make those steps simple for you. It might look like a black hole if you don't know what's all involved in it. We can help you make that process very easy.
As we wrap up this episode, I just want to point out that none of these examples you heard today just happened accidentally. Nobody woke up one morning and suddenly thought, wow, I'm recovering the cost of interest. Instead, they planned ahead for being able to recover the cost of interest someday in their future.
It's amazing how much a small amount of time can change someone's financial results. It's almost laughable when you look at stories like these, how little time it takes to plan ahead and then start getting results like these.
What are you doing to recover the cost of interest in your life? And what should you be doing today so that you can have greater financial freedom in the future? We're going to talk about all of that right here next week on Wealth Talk.